think if you look at 2 standard deviations to the downside, would put the gold silver ratio at 50 to 1. So if you just flip the coin here a little bit, no pun intended, you can actually see this run on that's basically an outperformance move of silver at some point, because when silver does move, it moves like a hockey stick. And so when you do get that, you get that sharp correction in the gold silver ratio. I think ultimately, when you see that move that it did in March of 2020, when it went to 125 to 1, I think that was like pulling a rubber band back that I think we'll never see again. But I think when you do have that one-sided flexive action, I guess, where it's very extreme, when that snaps back in the other direction, it's going to go just to an extreme in the other direction. So that's where ultimately you can see the gold silver ratio go down into the 20s to 1, so to speak.
So yeah, this was mentioned earlier, but clearly Western investors, pension funds, hedge funds, they've been shunning gold. So who's on the wrong side of this trade here? The Western investors, hedge funds, pension funds who are shunning it, or gold investors, and why?
Well, I think it's a cycle. You have probably a very low, I think it's like 0.5% weighting at the best in gold amongst institutions. It's a very, very small amount. What I found interesting is you're starting to see a perk up in Western societies or in the Western region, where people are starting to realize, hey, listen, if I miss the gold move as an institution or a money manager, I can still participate in the precious metals through silver. And that's where it starts to get interesting, because silver hasn't run yet. And this is where we saw that really large infusion of capital into one of the Wisdom Tree's physical silver ETFs or ETCs, electronically traded commodity, but it's part of their electronic traded products. You saw, literally it was half the amount of silver that is represented in the registered category at the COMEX, which basically backs all the futures contracts. You saw that amount of money come in one day into that fund. Just 25 million ounces, amazing amount of money. And then you saw in another fund, an iShares silver ETF, I think it was like 7 million shares, something like that, came in as well. I mean, just an enormous amount of money. So you're seeing people out there that are starting to recognize the move in the precious metals world, but doing it from an institutional perspective that says, listen, maybe I miss gold, but I still can participate in this move that I think is very early on in silver.
That'll be powerful for silver if the institutions are in there. So, Bob, is there anything in the 2008 through 2011 gold and silver bull run in the charts that has some similarity to today's setup?
Yeah, I put out charts before in the past that really looked at this sort of inverted head and shoulders type of pattern that after you had the 2008 sort of crash, then you had this rebuilding phase in the financial markets, and especially in the gold and silver market, you tend to see higher lows being made after that plunge. So it's like a stair step, 2 steps forward, 1 step back, and that same pattern has developed here after the after the COVID situation and going into 2022, when you had that massive move during COVID from 14 or 12 silver up to 28, then you had the big pullback. That pullback into 2022 created that sort of right shoulder, and it stayed firm because it got to a point where everything started going into backwardation. You started to see real demand for the physical silver start to dominate price action, basically hold the prices steady without further crash or deterioration. And since then, we've been stuck in this trading range, but building a base of lows that continue to show a similar pattern to where it's showed in 2008 to 2011. I mean, it's amazing how very similar these patterns have become. And so then you overlay that with other commodities over a period of 50 years, and you tend to see correlations with other commodities that are booming that tend to boom around the same times silver tends to then take off. And it's silver is just a reflection, I think, of confidence in the system at the end of the day. It's about the production, the cost of production, and that type of thing. But at the same time, it's also a monetary metal, so it is a barometer of people's trust.
Yeah. So, you mentioned the gold to silver ratio earlier. The historical mean is like around 50 or so, and yet currently it's close to 90. So some believe, I've been hearing, that the ratio is no longer applicable, that circumstances have changed and throw the gold to silver ratio out the window. Do you believe the ratio is still relevant? And do you expect a mean reversion in this cycle? And if so, do you happen to have a ratio target?
Yeah, to me, I think the ratio, if you look at a long-term chart, the gold silver ratio right now is above its 2 standard deviations above its norm. So if you look at it from a standpoint of being overvalued, that's where we're kind of at, because the naturally gold to silver ratio, it's about 8 ounces, 10 ounces of silver for every 1 ounce of gold in the ground. So to me, and that's really simplifying it. But I think if you look at 2 standard deviations to the downside, would put the gold silver ratio at 50-1. So if you just flip the coin here a little bit, no pun intended, you can actually see this run on that's basically an outperformance move of silver at some point, because when silver does move, it moves like a hockey stick. And so when you do get that, you get that sharp correction in the gold silver ratio. I think ultimately, when you see that move that it did in March of 2020, when it went to 125-1, I think that was like pulling a rubber band back that I think we'll never see again. And I hate to say that, but I think it'd be very difficult to see that again. But I think when you do have that one-sided sort of reflexive action, I guess, where it's very extreme, when that snaps back in the other direction, it's going to go just to an extreme in the other direction. So that's where ultimately you can see the gold silver ratio go down into the 20s-1, so to speak, because it did go into the 30s-1 back in 2011.
Mm-hmm. So is that what you're expecting in this cycle?
Yeah, and that's what I've been doing. I mean, the fund that I manage, not that it's just a full disclosure, I guess, because I do have the fund is invested in physical gold, silver, roughly about 72% silver, 28% gold, just for full disclosure. But I have been weighting higher recently, selling some gold, adding more to the silver position, with the idea that when this revaluation or in the gold silver ratio comes and silver does outperform, that'll allow to then sell the silver to buy more ounces of gold and add value that way. So some investors and some money managers will use the gold silver ratio to basically trade to maybe add more ounces at the end of the day during these big swings, especially when you get to these extremes.
Yeah, so it sounds like to me, and I don't want to put words in your mouth, but it sounds like to me that in your analysis and opinion, that the gold to silver ratio is still very relevant.
It is. I mean, you're looking at something that's 5,000 years old. So, whether our short time on Earth is irrelevant when it comes to this asset class, because it's like, I tell clients, I go, this is one asset that'll outlive not only us, but our, further generations to come. It's just the way it is. It'll even outlast every empire and civilization, let alone, family generations. That's just the problem is you just happen to have cycles within all these moves, and you just got to be patient. And that's why I've always been very pragmatic about owning the physical, not getting involved in the paper, because one, you could have, especially in mining companies, things can go to zero, or before that time actually ends up moving, that paper instrument, especially if it's on leverage, could really impact your portfolio before that move finally comes. But whereas the physical paid for in cash, it's time in the market. You're just waiting and being patient. And yes, I know it's after watching the cryptocurrencies, it's like, you could do 5x in a week in some of these cryptocurrencies, and for silver it takes 15 years to do maybe a half x. But I think it's one of those things where it's a very it's this long base that this thing has been building. I think, like you mentioned earlier, could really be a setup for a very strong move.
So can you tell everybody why it is so critical that everyone owns some gold and silver, and what allocations do you recommend for the average investor, the average person who's listening?
Yeah, I mean, in terms of their allocation, it really depends, obviously, on their risk-taking type of mentality, where they're at in their life, from a life perspective, in terms of their cost structure, their income structure, whether they're retired. I mean, I think there's been studies done that gold and silver added to a portfolio over a 50-year study, I think it was, actually up to a 25% weighting, actually reduced risk and increased return of that portfolio going back that 50 years. And I think that was a study done from like 1970 to 2020, I think it was. And the reason behind it is that gold and silver are typically non-correlated assets. They typically will move when the markets move against, go down. That's when the metals tend to do well. And it's just, again, it's a diversifier to a portfolio. Some people may only do 5%. Some people may do 10%. But you want to be careful how you own it. That's the most important thing. So if there's one thing I could kind of walk away with the interview from for your viewers, is that if you're owning ETFs, yes, they're great trading vehicles. But if you're using them as a store of value, that you have to understand the structure behind it, the legality of it. You don't own an ETF share when you're in a U.S. brokerage account. It's owned by Seed & Company, which is a limited partner of DTCC, Depository Trust Corporation. So you're just a beneficial owner. So throw the idea that you're even going to get, you don't even have access to the metal. You don't even have ownership of the shares to begin with. And so just understanding that allows, when you're buying physical metal, you're buying a private asset that you're taking legal title of. And again, how you store it is another question, whether you store it at home or with a professional facility. Make sure you store it on a segregated basis, because when you do that, you're not pooling with other people. You're not using fractional ownership. It's not an unallocated type of environment. So you actually have direct ownership. So when you bought something, you're taking the exact same thing back when you take distribution.
Yeah. And so all of that is great advice, and I appreciate you sharing that. And you had mentioned some numbers there of 5 to 25% ownership of the physical, depending on, where you are in life, your tolerance levels, et cetera. What's interesting, just to put it in perspective, I think, is that the mean average right now of ownership is less than half of 1%. Isn't that right?
Yeah, I think you're right. I think that's the numbers that I've been kind of reading as well. It's pitiful. And I think I even read where I think Bitcoin, a crypto portfolio, actually has more weighting in the average portfolio now than gold and silver does. Which is, I get it. I mean, the prices have gone up on crypto, so you just have the appreciation of that alone may increase the weighting. But I think it just goes to show how unloved this asset class really is.
Yeah, and that could be the very thing to help it climb that wall of worry, like you had mentioned a moment ago. I think this is a good spot to transition over to silver in earnest here. Bob, we keep hearing that silver is in a deficit, but that the data seems a bit cloudy on this topic. Is silver in a structural supply deficit, and how severe?
Yeah, it depends, I guess, what's research firm you talk to. There's some that will, I guess it boils down to the idea of using silver for investment purposes, whether that is actually the same thing as silver that's that's used in industry and fabrication. And so if you take away silver for investment purposes, that's held in ETFs and things like that, you don't run those deficits. And so I guess it's which way do you kind of look at it. What's interesting though is if you look at London inventories, for example, or even the COMEX inventories, you've seen a big drawdown of silver inventories, especially I think you're at about 152 million ounces in 2020. I mean, it jammed straight up from like about 50 million to 150 million, and now it's come down. It went down as low as I think 26, 27 million ounces, and now it's come up to about 48 million, something like that. So, but it's still well below where its highs were. London inventories, you're seeing the levels back down to the 2016 lows, and part of that is this. A lot of the ETFs that hold silver hold it in London. It's a more of a London-based product. So you have JP Morgan. There's a little bit of SLV that's held in New York, but most of everything is held in London. And London has been seeing a lot of outflow of that metal going to India and China and other countries. So the OTC market, which has sort of prospered in this time where Basel III has been very structurally limiting banks' participation in the gold and silver market on a leverage basis through unallocated type of accounts, the OTC market has sort of blossomed, and that has you've seen a lot more activity there, and that flow has it's like kicking over an ant hive or ant hill. It scatters the product going into many different jurisdictions. And I think rather than keeping us segmented into an exchange-oriented type of environment or centralized environment.
That's interesting. So, the demand side for silver is very encouraging. Can you speak into that, what you're seeing on the demand side?
Well, yeah, I mean, obviously India bought for the first 2 months of this year, more silver, I think, than what was produced or bought in the United States all of last year. I mean, it's just an enormous amount of demand out of India. And then of course you've had the recent purchases in these European ETFs, which you have to really watch this stuff and watch the flow, because it's not just me watching it. It's not just an investor sitting someplace in the middle of nowhere watching this. Other money managers are watching this stuff. Algorithms are watching this stuff, and if they start seeing money flow starting to appear in large size in certain asset classes or certain funds, certain publicly traded vehicles, they're going to start perking up. They're going to start zeroing in on that type of stuff, and that's where you start to see this again wall of worry develop, and bears that are saying, hey, listen, the Fed's not going to be cutting rates anytime soon, and we're going to have an implosion in the markets, or whatever it may be. That super cycle is going to end up blowing up. Whatever it may be that people, or the dollar is going to rally, or whatever it may be. If that doesn't come to fruition, those shorts will then start to see more pressure to basically cover, and then you'll see the market unwind and price to the upside. And that's exactly what happened in 2011, where really the futures market and sort of the role of the contract, basically selling, basically rolling out a 1 month going into a forward month. That actually is what really shot silver up into April to back toward that $50 area.
So silver is increasingly difficult to find and produce while demand is continuing to rise. Mine output seems to be falling while mining costs are surging. None of this has seemingly been reflected in the price of silver, as it doesn't seem to be able to break through resistance at $26-ish. It seems to be bumping its head up against that. So miners have been taking a beating, right? So Bob, something has to give here, right?
So basically this chart is the SLV, and then I threw a couple of things on top of it. So the SLV is this sort of bar chart right here, candle chart. And then you have the blue lines, which is actually the short sell volume. and this chart is going back to 2021. So it's a little bit condensed. I apologize for it's not as spread out. But what I'm trying to show here is the shorting that's been going on lately. So basically the blue line is the short sale volume. And then this lower chart right here, which it's not perfect, but I try to represent it. This is the SLV shares outstanding. So this is that share creation. That kind of represents how many ounces are in the fund, if that makes sense. And so I try to kind of get this correlated with the prices on, from the chart. So you can kind of see as the price has been going up here lately, right here, you could see that you've had this sort of decline in shares in the SLV. That's been this sort of discrepancy or divergence that a lot of people have been talking about. Well, as you got this rally into SLV, into silver, an odd thing happened. You started to see a wave of shorting that started coming into the market. And unlike like in past instances where, the shorting was maybe one day, one big spike or maybe two big spikes, something like that. This was a series of about 3 weeks here. That this cluster, I guess you can say, you did it. I mean, yes, in 2022, you saw a big amount of shorting going on, but that's actually when the Russian invasion happened and you had, a big spike in price. You didn't have the shorting begin during the liftoff. And so, what was interesting is you didn't see any new ounces come into the fund. There was no share creation with SLV, if that makes sense, during this big move. So the question is did either authorized participants or market makers, or did our hedge funds shorting SLV as a proxy, for example, instead of maybe the futures market, somebody was shorting this market all the way up, expecting for this thing to fall right back on its feet again. And you saw the short interest, or I guess the shares of short grew from about 15 million to about over 30 million shares short during this last about 2.5 week period. I mean, it basically doubled the share short in SLV. So this is an interesting dynamic that, if the price stays strong here, which, you kind of see everyone's seeing the same thing. They're like, oh, this thing's poking right up to the top end of the range. It's going to come crashing right back down, and we're going to cover the shorts, and we're going to make money, and we're going to do it all over again. And then we're going to buy the lows and rally it right back up. The interesting thing is, when you see these like inverted head and shoulders that are building right here, and you have this little head, and then you have this, this right shoulder right here. If this thing doesn't go back down, this is what you call climbing that wall of worry, and then you're looking at that breakout of $26. That'll catch a lot of people by surprise. Thus, anyone who's left short may have to cover at that point. And that's the risk of being short, is that the prices can go technically to infinity. Not saying silver is going to do that, but that's the risk you have. You have an unlimited risk for a limited amount of return when you short something. And that's what I'm kind of watching here.
That's interesting. Bob, you recently shared another chart, and it was of the cattle market overlaid with silver going back 50 years. You wrote that rising food prices tend to create uncertainty, which helps hard assets. We see a pattern of surging cattle prices and spiking silver prices within a short time frame of each other, and cattle prices just surged. Can you detail what you see in this chart and what your expectations are?
Yeah, if you go back to the 70s, which is, these highlights are basically the moves in cattle. And whether it's cattle or cocoa, I did another chart with cocoa. These moves are inflationary based types of moves in commodities. This is due to the money printing that we kind of saw in the 1970s, obviously with the price of oil going through the roof, that type of thing. Price of gasoline at the pump, all that had impacts. And so cattle, for example, tended to lead this move first, and then silver kind of followed in its footsteps. Same thing here in 2001. You had the market, the tech boom blew up. It topped out in 2000. commodities and value-oriented type investments started to take off in 2000, 2001. And lo and behold, the cattle market took off first. Silver kind of followed up second. And then as the markets kind of moved, silver kind of exploded out of the gates here. Well, interesting enough, you had actually, I'm sorry, this is the cocoa market, not the cattle market. I'm sorry.
Well,
But
that's fine, because I was going to ask you about the cocoa market anyway. So
yeah,
so that's fine. Yeah.
sorry about that. Yeah, getting cattle and cocoa mixed up. So cocoa again just took off. And again, you're not saying silver is cocoa. You're not saying silver is, it's not plentifully planted and you're going to have, bad crop season, therefore silver is going to go up irregardless. No, what it's telling me is that there is underlying inflation in the system. And if you have a supply issue with any commodity in a highly potentially inflationary state, that's when these commodities can really take off. And this chart actually with cocoa, it was, I think this was done about 7 days ago. So, it's only at 7,500. I think it went up to 10K recently here on the contract. But you can see as cocoa takes off, silver's basing here with this inverted head and shoulders forming. You have the potential here for this breakout to the upside that is, I think a lot of people it's almost like unexpected. And the funny thing about the metals is they tend to move when most people least expect it.
Right. And what's interesting about this chart is, like you said, cocoa leads, silver follows, but cocoa peaks, it could be even a couple of years. It is a couple of years, and then starts dropping before silver peaks. So silver lags, but it goes on. It looks like to me, it goes on for a number of years after.
Yeah. Okay. So this is the cattle chart. Silver is basically circled green here, or basically it's circled with these corresponding moves. The cattle market basically sort of almost doubling in price right here in the 70s with this move. Silver kind of took off as well. Then you had this long consolidation, and then all of a sudden, in the 2000s, that's when commodities took off again. Cattle and black kind of started, breaking out. Silver broke out with it. In this instance, silver kind of spiked first, then cattle, and now you had this massive run in the cattle market. The last few years, where silver again is just building that base. It's just sitting there dormant in a way. And so, you look at these spikes and these large moves, not necessarily the little bounces and so forth, but when you see these big gigantic moves, it tends to have some correlation there. Not to say that, again, cattle and silver are tied at the hip, but it's showing you that, if food prices start going up, that creates uncertainty. That creates worry amongst the consumer. That creates the idea of, hey, my purchasing power is going down. I need to get into something that will maybe protect that purchasing power. And that's when the metals kind of start to come into play, if that makes sense.
It does. And each cattle spike seems to be followed by an even bigger silver spike. So you have from the 70s to the early 2000s to now, the cattle spike has gotten bigger each time. And the first two silver spikes got bigger. However, now we have this divergence, this anomaly.
Yeah, and that's the part where you're looking for as the markets tend to broaden out, and this so-called melt up that kind of happens in the stock market and commodity markets are broadening. You see it obviously with digital assets. These funds will start looking at these types of charts. They may look at relative valuations. They may look at, hey, what hasn't moved yet? What's cheap relative to something else? That's all part of their formulas. And so it's not like it's rocket science, but you're just, again, you're trying to show the investor out there or the person that's invested in an asset, hey, this could be a catalyst I guess no pun intended, but to actually go higher. I mean, it could be this, very similar chart pattern that you're seeing that played out before in the past. Well, it could if it's happening with other commodities, and with gold breaking out, this is what makes this pattern very interesting. Silver hasn't broken out yet, and yet people have been shorting SLV in a very large way. It's telling you that people aren't believing that silver is going to break out through 26. They're betting on it, and that's a dangerous thing when you're seeing the gold market break out to new all-time highs.
Yeah. Yeah. So, what you've shared here in this discussion is so many really positive pieces of the puzzle, excuse me, that point to both gold and silver rising, in this cycle in the coming months and, hopefully years ahead. I want to shift us over to the miners real briefly. Bob, do you have any reason to believe that the mining companies are purposefully holding back production? And if so, why would they be doing that? And what do you expect to see happen from that in what time frame?
I don't see them purposely holding back production. If they were maybe rolling forwards, like last year, trying to maybe get higher prices for their product, but I don't think they were purposely holding back production from a standpoint of we're going to show the banks or we're going to show somebody else, how the market's driven, because most of these miners are debt laden. They have commitments that they already have. They're maybe hedged that production anyway, so they have to bring it to market, or it may have offtake agreements that production is really already spoken for. I mean, there's the mining industry is certainly, the participants in it has broadened since the old days of, hey, banks were basically everything from capital financing to hedging to to movement of the product, so to speak. It's become, the mining business, what's been hurting them more is really the lack of production, or silver peaking out in production back in 2016, the lack of finding large deposits, the cost of maybe buying a junior miner and developing that mine versus trying to find and explore mines on their own. I mean, it takes capital. It takes, the EPA and environmental restrictions. It takes 10 years to bring a mine to fruition. So there's a lot of friction that gets into the mining business, as well as, capitalization is very difficult right now in the mining sector. Mining companies trying to get capital just to expand operations it's not politically correct, I guess you could say. So that they tend to be fighting that as well. And of course you saw, in the 2000s, 2010s, you saw a lot of shenanigans with mining companies taking advantage of investor capital and just blowing it. You saw mining companies with their hedge books just blow up and come to market with, $7 billion, $5 billion in equity dilution or debt to unwind their hedge book losses. I mean, so investors have been burned in the past, owning mining companies. So that it's, why take the risk when I can just buy Apple? Yeah,
it's a fair point. So, with all the things that we've discussed, fiscal, monetary, economic, the markets, the high cost of the mining, the decreased supply, et cetera, et cetera, et cetera. Are we starting to see, or is all of that enough of an alphabet soup to create a bull run for the mining equities as the precious metals climb the wall of worry, et cetera? And do you see more of a baby bull run, like a 2015, 2020 bull run for the mining equities forming? Or if you do see a bull run, maybe more of a historic, 1970s, early 2000s type?
You certainly can have mining companies. I think I look at mining companies as a trade, not necessarily long-term investment. And you can have periods where they can really rip and outperform the metals and do extremely well. I mean, you just kind of saw this with the recent move off the lows. And if you got in 3 weeks ago, you feel like you're king of the world. I mean, there were some pretty big moves that happened, but the funny thing is a lot of these mining companies are still negative on the year. They haven't done anything. And gold's broken out to new all-time highs, and that's a very frustrating thing, especially if you're a large investor in a large mining company and you're saying to yourself, what's going on here? And I think it's this idea the metals are kind of a unique asset class in that institutions that are coming into this may be looking at this, especially in the OTC markets, as a counterparty risk, systemic risk type of offset of an asset, rather than this idea I'm going to make it rich, because all this money printing, all this debt creation is creating more uncertainty going forward. And as the debt markets get bigger and bigger, gold is actually a great hedge in a fixed income portfolio, not just for equities and diversification from currencies. So maybe the institutions are looking at the metals as a alternative to owning or having more exposure to bonds. Maybe adding this because it may have sort of that non-correlative moment where, hey, bond prices go down, gold may actually go up, so to speak, especially if you're longer in duration.
And certainly, if the wall of worry is in fact climbed and prices get up several hundred or more from where they are today, hedge funds and other savvy folks are going to be looking, saying, well, there's got to be some money being made by some of these miners, and that's probably when they would move in once the profit margins really start expanding.
Yeah, I mean, it's not just the profit margins. You just need to see capital coming into the sector, and momentum will drive that price action alone. I mean, but there's a lot of political issues going on right now. There's a lot of issues with, you look at Mexico, for example, this idea during their election time, they want to ban open pit mining. I mean, does that make you want to go spend $1 billion to dig a pit in the ground? I don't think so. The risk that inflation is starting to impact communities in these mining sectors, and especially in these countries. The costs of business in these mining areas and jurisdictions, is going up faster than the product is, and the product is priced in dollars. The expenses are priced in local currencies, and so if the currencies are ripping to the downside, creating more inflation and cost pressure and more concern amongst consumers down there. That's only impacting the local mining company because they're not able to see their product you come to the U.S. markets or to the main markets like in London rising faster in capiple or in value.
And eventually, though, if if the investment dollars just stay where they are, if they're just if it's a dry seabed, then where does the eventual supply come from?
Well, there's a cure for that, and it's called higher prices. I mean, at some point, everyone has a price, I guess you could say. Was it The Godfather? I guess. But that's how the market works. It's not that it's nefarious and everything is manipulated to the 10th degree. Prices will eventually rise, and people will sell. They will go into other assets. The sun will rise in the east and set in the west. That'll come. But the metals, I think, are a very unique asset class that tends to do very well during times of chaos and uncertainty, and for people that like me as an investor, those are the times where you want to own the metals, because from point A to point B, I don't know what to expect, but at least I have an asset that have any counterparty risk, and it protects me from systemic risk.
Exactly. Yeah, this has been a great conversation. Before we wrap up here, and I ask Bob our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and of course, all of the interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift. Also, Metals and Miners is a new channel. We're less than 2 months old. Please comment below. Tell us what information you want to hear about, or just tell us how we're doing. If you've enjoyed this conversation with Bob as much as I have, please let him know. Please hit the like and subscribe button and leave that comment below. Bob, in wrapping up our discussion, I've got a question on positioning for you. With the market and the economy backdrop, as we've discussed here, what asset classes are you staying away from, and what asset classes are you either in or moving into?
That is a great question. I think I'm not a big believer of the digital asset space, especially a lot of these tokens and so forth. There's a lot of froth there. There's a lot of speculation. I mean, you see the memes, and you see these sort of seminars that are put on that are just talking about 300,000, 1.3 million. I mean, it's throwing numbers into the wind on not just Bitcoin, but all tokens and so forth like that. You really got to be careful if you're trading those things to treat them like a trade, not a long-term investment. I think that's one area of concern. In terms of the stock market, you look at these technology names, which have gone through the roof. The technology names are really, sort of tied at the hip with the digital token age. And the problem is when you have a downturn, I think, in the digital tokens, and I kind of call it the first, the end of the first digital age, because you have so much friction out there with regard to spyware, malware, and hacking, and it's becoming, talking to a lot of the cybersecurity experts out there, it's getting more pervasive. And then you have, maybe a year and a half away, 2 years away, you're going to have quantum computing. So, what does that mean to all this, 256-bit encryption and all this other types of stuff? There's going to be a lot of pressure coming into this sector. I think right now it's riding on a wave of optimism and euphoria, but you got to be really careful getting caught up in that, especially when you see these moves that are just going absolutely vertical. So that those are areas where I would be more cautious over. I think you just got to look at asset. Look at the markets that are starting to broaden, and sort of, you look at companies and industries that are kind of riding this coattail of spending by the government, because that's ultimately what you got to understand, what's driving the markets. And I think looking at industrials and that type of thing that can benefit from it, this is all potentially a great trade right now. But the question is, you got to think about this type of stuff when you do go into an investment. Think about the long-term scenario. Do you feel comfortable owning this thing, 2, 3, 4 years, or is it just a trade? And so if you think of it as a trade, put in stop losses, things like that says, listen, I have a firm out. If it goes down, I'm done. Be careful. Don't go on leverage. Stay away from that. Obviously, right now there's a big hooray with 0 days to expiration options, and just the option market in general. Sort of the tail wagging the dog, but just as an investor, just try to take a little bit longer term view of this marketplace right now, because it is being driven a lot by the election and sort of the actions of government, so to speak, wanting to put money into the markets, into the economy to prop it up.
Yeah, it's all great advice. Thank you so much for that, Bob. Thank you for coming on to the Metals and Miners podcast, for being so generous with your time analysis and ideas. It's been really good to spend this time with you. Will you tell everybody where they can learn more about your work and how they can connect with you?
Yeah, definitely. Our website is www.goldsilvervault.com, all one word, Gold Silver Vault. And then you can follow me on Twitter. I put a lot of information out there, and that's Profits Plus ID. So it's PROFITS PLUS ID is in Idaho. I put a lot of charts and commentary. Sometimes I have a dry sense of humor as well.
Yeah, and I think if the last hour is any indication, folks, you understand what you're getting with Bob. I've been following Bob for a while, and I really appreciate your perspective. So everybody go follow Bob, and thank you again for spending this time with us.
Appreciate it. Thank you, Gary.